Afternoon, everyone, for joining us today. Welcome to our annual Outlook webinar event. We're happy to have you all here as we share with you our perspectives on the market, the economy, our client solutions and investment strategies, and more. And while the past year was excellent in many ways, we know that today's jittery market movements are raising more than a few eyebrows. We see the volatility and believe there are very valid reasons to be concerned, but there are also a lot of reasons to be optimistic as well. And we'll get to both of those throughout this presentation. But first, introductions. My name is Jerry Guger, Head of Content Strategy at Manning & Napier, focused on bringing you the unique views and perspectives of our firm. And I'm excited to be joined here today by Greg Holden. Greg is the Managing Director of our Wealth Management Group, including both our private client practice serving families and individuals, as well as our endowment and foundation service offerings. Greg remains a practicing senior financial consultant working with clients across the southeastern US. He joined us 12 years ago and has been focused on bringing solutions to our clients ever since. He's a leader in his community, as well as a leader within our firm, and is knowledgeable on both investment and financial planning topics, and basically everything except the weather, because I know he's coming to us from Florida and I'd rather not get his opinion on the 18 inches of snow outside my window. Greg, welcome.
Thank you. Good to be here.
And I'm also joined here today by Ebrahim Busheri, who has been a staple on these events for several years now. And for those unaware, Ebrahim is the Director of Investments at Manning & Napier, in charge of running our entire research department, in addition to his responsibilities as a member of the US, non-US, and global core teams. And before that, Ebrahim spent time focusing as the lead of both our consumer and technology sector groups. And I know he remains a bottom-up analyst at heart. Ebrahim, welcome.
Thanks, Jerry.
Our agenda today is as follows. We're first going to start with a brief look back on Q4 in 2021, I should say now. Years changing quickly, and the outlook for the year at hand being 2022. We'll then share how we are putting our big picture views from that outlook into our solutions for clients, both on an investment portfolio and a planning standpoint. And after that, we'll cover a number of pre-submitted questions sent in before today's event. Thank you. We got them running the gamut, a large number, and we'll get to as many of the broadest questions as we can, and we'll take some live Q&A as well. And as a reminder, we do encourage you to submit those live questions at any point throughout today's event. And lastly, and before we dive in, I do want to take a moment to provide a few firm updates to all of you. In the past year, we made huge strides as a firm and within our wealth management practice, especially, not only in client results, which we'll get to, but in many other verticals as well. We received external validation from a variety of national media outlets, recognizing all that we did accomplish from an investment perspective over the past year plus. We invested in our communities in what has been a trying time, and we know, and we recently released an impact report detailing all of those things that we have done for our communities. We've also launched a number of technological improvements aimed at improving the client experience, including a revamped client portal, among other areas. And going forward, we have a number of additional strides on the horizon as well, more advanced tax management tools, further technological enhancements, additional community outreach, diversity, inclusion, and efforts beyond just those as well. We're really proud of all that we've accomplished, all that we are set out to continue to do in the years ahead, and we want to make sure we share that with all of you. So with that, Greg, I'd like to turn it over to you to talk about a theme of today's event.
Thank you, Jerry. As I look at this quote, if you don't know who you are, the stock market is an expensive place to find out. I suspect that resonates for a lot of folks on the call today. It might feel silly sometimes to have an investment plan and stick to it, especially when others seem to be making really easy money. We've seen that, right? Crowded momentum trades, sometimes whatever appears to be the flavor of the day. While the market sometimes seems random and irrational, it's also really hard to outsmart. And I think as we look back and use that to inform looking forward, things have been really, really good, perhaps deceptively good. 8 of the past 10 years that we've lived through were positive for the S&P 500. 7 of those were double digits, most of them meaningful double digits. The only 2 down years that we had were low single digits. Things have been good. They've been so good, it's going to be hard for them to get a lot better, broadly speaking. Now, the irony of that is I think the last time we were talking along those terms, and I was having these conversations with clients, it was January of 2020. We were starting to back down our asset allocation, not with anything specifically in mind in terms of a catalyst, but just looking at the broad conditions. I'm going to be clear. We are not suggesting that 2022 is going to look like 2020, but I think the easy money has been made at this point. And I think that, is part of the theme here that we're bringing today. And it's just hard to ignore some of the serious enthusiasm that you see out there around hot growth names, around private equity, venture capital, and the likes. Certainly real estate, we'll talk about that. I know our clients are seeing that in their personal residential real estate and commercial holdings, and in pockets of the equity markets. And all of this despite some big dents in the past few weeks that we're going to talk about. Loading up on risk has almost become the status quo. Certainly, if your news source is Twitter and CNBC. And so I think our view is that there's a shock coming to that status quo. Now, just like with the tech wreck, that shock doesn't mean that those investments aren't real, that they're not viable, just that there is a reset. We had clients last year. I and my colleagues took a lot of calls from frustrated clients that didn't own Netflix, Tesla, and many of the other hot, high growth names. The past few weeks, I'm thankful our clients aren't experiencing the back end downside of some of those names. And I guess I'll also frame as we start out that despite our cautious outlook that I think you're going to hear from us, there are always opportunities present. And in fact, you often need volatility to be able to uncover meaningful opportunities. And I'll draw that parallel again back to 2020 and some of the other periods. Sometimes the greatest volatility is where you have the greatest opportunity. So I'm looking forward to talking about some of those opportunities today. Wouldn't want to do this with anybody other than our director of investments and my friend, Evie. And so Evie, let's take a quick look back at the past year and maybe use that as our launching point to look forward.
Thanks, Greg. And thank you to all of you for joining today's webinar. So you can see on this chart, despite higher inflation, interest rate concerns, and the Omicron variant emerging, the market powered forward with the S&P 500 up 11% in the fourth quarter. This built on strong returns in the first 3 quarters as well, and the S&P 500 was up by 28% last year. The market can be volatile, as we are being reminded over the past few weeks, but it's also important to remember that the stock market is a good place to invest over the long term. A volatile market environment is also when an active manager like Manning & Napier has the best opportunity to add value through asset allocation, through sector allocation, and also through security selection. I spoke about putting things into context and a longer term viewpoint. This chart goes back to 1996. The gray area shows the strong pullback with the tech bubble bursting in 2000, and then the real estate bubble bursting with the global financial crisis in 2008. I remember both 2000 and 2008 very clearly, and our focus in both those environments to protect clients through asset allocation, sector allocation, and security selection. But a really important takeaway from this chart is that despite the tech bubble and despite the global financial crisis, the market has been a great place to be invested. Even if you invested at the peak of those bubbles, you have done very well. Barely visible, but there's a third gray sliver that you will see, which is March of 2020 in this chart. We protected clients well in that environment as well by employing the same tools that I've spoken about. Today, inflation has increased, interest rates are increasing, and we are in a more volatile environment. So as Greg was saying, yes, the risks have increased in this environment, but this is also a great environment to be an active manager.
It's also a good reminder, Evie, that hindsight is 2020, right? When I look at this chart, those gray periods look so small in retrospect, right? Of course, we all knew the market would rebound, right? the reality is those gray periods were really hard to live through for us, for our clients. And that's easy to forget. We as human beings tend to remember the good and forget the bad. Ironically, those have been some of the best periods for managed peer clients, given our approach being based in risk management. We all know we're supposed to buy low and sell high. Most investors benefit from professional help to hold emotions at bay and actually be able to accomplish that objective. So risk management matters, and so does having a plan, right? With a flexible approach that you can proactively adjust, asset allocation helps navigating these turbulent markets and helps clients stay on track towards their financial goals.
That's correct, Greg. And again, keeping with a longer term perspective, this next chart goes all the way back to 1926. What it shows is basically over a 1 year, 3 year, 5 year, and 10-year time horizon. What's the best the market has done, and what's the worst the market has done in any 1 year, 3 year, 5 year, and 10 year. So if you look at the bars on the left, you'll see basically the best 1 year return in the stock market has been up 44%, and the worst has been negative 22%. The star that you see signifies where we are currently, meaning last year was among the better years that we've had since 1926. If you look now further to the right, the 3 year, the 5 year, and the 10 year, you see the star is pretty much all the way to the top of those bars. That just signifies that when we look back, we've just gone through an extraordinarily good period for the stock market. And it's important to basically put that in context and to be mindful of returns going forward likely not being as strong. But I don't want to move away from this chart before touching on maybe the most important thing. The longer the time period, as you see going towards the right, the likelihood of having negative returns from the stock market disappears. So a great place to invest in the long term. I'll touch on valuations if I could. So this next chart that you see shows the PE ratio going back over the past many years. So the superior returns I just spoke about have partly been a function of the fact that valuations shown by the price earnings ratio on this chart have gone up. Valuations are elevated, but this is a reminder that valuation, while a very good predictor of long-term returns, is a pretty poor predictor of short-term performance.
Yeah, Evie, I might reinforce here two things, right? Price earnings ratio is P/NE, right? There's two pieces of that equation, both of which can move and adjust this. And so I think a lot of people pay a lot of attention to valuation. It's a big driver in our process. But it's also worth noting here, we're bouncing between charts, sometimes showing the market, right? And sometimes showing Manning in the peer. Obviously, this is reflecting the valuation of the broad market, not necessarily the Manning in the peer portfolio. And because of our investment and risk management process being so focused on valuation, we're not contrarian for the sake of being contrarian, but there are times where we tend to be a bit contrarian to a chart like this, right? We are often that old mantra of getting greedy when others are fearful and fearful when others are greedy. Again, that's not the strategy, but it also echoes a little bit of what we look like and what we tend to do. I think in this environment, while we have been incrementally backing down our equity weight in some of the flagship multi-asset class portfolios, certainly doesn't mean we're not finding opportunities selectively, as we navigate through valuations.
That's exactly right, Greg. And we'll speak maybe in a little bit about the specific opportunities that we are finding and that we are excited about. This next chart shows GDP growth going back to 1980. Last year saw significant growth. This was a rebound from the COVID recession of 2020 and was based on a lot of fiscal spending that took place from Washington. Just to put the fiscal spending in context, we had more per capita fiscal spending last year than we've had in the global financial crisis, but frankly, even more than we had with the Great Depression of the 1930s. It's unsustainable. And as this fiscal spending comes back, as we move further into the cycle, we expect growth, as you can see here, to slow this year and over the next few years. Some of the secular things that you've heard us speak about over the years that have kept growth at a lower level, high amounts of debt and demographic issues continue.
There's a lot packed in. And to me, this chart is also a good reminder that the stock market does not equal the economy, right? They often track, sometimes they echo, but they are not always going to correlate. And you can see here, as you look at the growth rates, incremental declines over time, right? You've got higher growth rates in the 80s than you do in the 90s, in the 90s and in the 2000s and so forth. Ironically, though, yet despite that slower growth through the last decade that you touched on, that our outlook really included and anticipated, you still had record stock market performance. So you look and you ask why, right? And of course, you unpack that, and it's important to understand why. And the last decade was heavily based around multiple expansion, was based around stimulus that you just referenced. And you take those, neither of which are likely to provide the same tailwinds for the next decade as they did in the past decade. So again, not a pessimistic negative view, but just a realistic view of kind of what, how the table is set going forward. I think the good money, the thoughtful minds today, I think are in agreement. You're going to have to find returns the old-fashioned way with good businesses if you want to achieve your goals going forward.
Greg, you raise an important point related to the correlation between the economy and the stock market. So what happens in the economy overall, shown by GDP growth on this chart, clearly impacts the environment and impacts companies' ability to grow. But it's not so simple as to say that when the economy is growing, the stock market does well, and when the economy is shrinking, the stock market does poorly. We've seen many, many examples of the opposite play out. Probably a great example is 2020. COVID, deep recession, the stock market had a great year. I'll take us back, if I could, to 2008 and the global financial crisis with the real estate bubble bursting. If you try to take yourself back to that time period, I think it was generally widely felt that we were in for like a bad decade, as we had to pay off the debt we had accumulated and the excesses that had occurred. We saw a few charts earlier. It's been one of the strongest bull markets ever, despite relatively low growth. So important to keep these factors in mind, but also important to kind of dig a little deeper. If I could, on the next chart, I'll touch base on inflation and then shift into interest rates as well. What you see in the top part of this chart is inflation going back to 1960. And what you can see is this, we did see high inflation in the 70s, but really going back almost 40 years, we've had a period of relatively low inflation. That changed last year. Inflation reared its head and, as a matter of fact, finished the fourth quarter being up about 7%. But to put that in context, the bottom chart shows that the market expects that inflation will slow going forward. So inflation is clearly a major risk, and it's something that we are watching closely. But we do believe that it's likely to slow from levels that we saw in the fourth quarter and last year.
And I think there's a nuance to this message, Ebi, that I'll build on your comments. I think sometimes gets lost in today's kind of news media cycle. We're being very clear with our clients that inflation is real. It's very real. We know it. We see it. We know our clients are seeing and feeling this. But I think the counterpoint to that is it's not a time to be panicking. Prices are up and they're not going to likely go back down. But inflation is not just the move up and does it go back down. Inflation is really measuring the acceleration of continued price increases. And so I think that's what I'd build on your comments, right? As we want clients to know we're watching this closely, but we are not nearly to the point where we believe things are out of control, right? When you hear about periods of very high inflation, is that possible? Sure, right? Is it something we're monitoring? Yes. Are we there? I think I hear you saying, no, we're not there yet, right? And I think as you look at this chart, the data here supports that outlook, right? That inflation will continue to be elevated for the near term, but it's going to cool and back off as we move forward. And I can't not note again, as I think about field-facing comments and what I want our clients to know, as an active manager, we've got an important tool in our bag to be able to orient the portfolio towards businesses that can drive their own destiny, right? Inflation's a concern across the board. Can it devalue the dollar? Can it devalue assets? Yes, right? But the place to go is not hoarding cash and saving under the mattress, of course, right? One of the best tools that you've got to combat that is owning businesses that can pass along the cost increases that they see, right? Owning businesses that are necessary, right? That are viable and that people are going to continue to patronize and to purchase from, even in a more challenging economic environment. And so, I think having that weapon as one of the best that investors have to combat inflation, it's one of the things that, given our selectivity bias and our approach, our clients are probably in the catbird seat here, given the experience of your team.
That's well said, Greg. I think in an inflationary environment, by keeping money just in cash over the long term, that's a guaranteed way not to be able to keep up with inflation. So yes, there's more volatility that takes place in this environment, but there are ways to invest in companies that have pricing power, that have the ability to gain market share, that really in many cases have disruptive technologies that enable them to grow. It's part of what played out well for our clients over the past decade and longer, and we expect to continue to find those companies for clients going forward as well. Speaking of inflation and why we expect it to slow, there are a variety of reasons, including supply chain bottlenecks getting resolved, et cetera. But as this next chart shows, one of the main reasons is the Fed is now expected to raise interest rates by 4 times, 425 basis point increases is what the market's expecting in this year, in 2022. This is not a positive for bond markets and can also be problematic for equity markets. But the combination of these factors, I think, is likely to cause inflation to slow down as we go through this year. The next chart shows bond market returns on the top. As you can see in the government part of the bond market, whether it be very short-term time horizons, 3 months or even longer, 5-year, 10-year or beyond, bond market returns are relatively low today. Now you can get additional yield beyond what's shown in the top part by going to the bottom part, by buying investment grade, high yield or municipal bonds. But as you can see, the spread between the two is also relatively narrow. So relatively low returns in the fixed income part, but by going into different areas, including high yield, our unconstrained bond fund, and other areas, we believe there continue to be opportunities in the same way, Greg, you were referencing the opportunities on the equity side.
And with these rates, I'll just, call out the elephant in the room because we hear it from clients. It begs the question, why own bonds at all? Right? I mean, these are definitely low rates. It's a tough period. And let's be honest, for an investor, truly, that has a long time horizon and no withdrawal needs, why own bonds is a reasonable question. And it's worth further discussion with your financial consultant. But the reality is that most of our clients do care about near-term volatility. And furthermore, that near-term volatility can drive investor behavior. Avoiding selling low and trying to time the market is arguably the most important thing for any investor, right? And that's a lot of what we provide at a very base level to our clients. But the other piece is that clients, whether they be individuals, whether they be endowments, most clients do need to make a regular withdrawal. And having some bonds is important to help meet those liquidity needs, especially during a period when stocks might be down, right? You may not want to sell stocks at that moment in time, and it's good to have diversification amongst asset classes. Having an active approach here matters as well, right? We are not simply laddering bonds. There is a pretty sophisticated, robust fixed income team that's able to navigate maturity, duration, sector, credit. They're working across the fixed income landscape to manage risk. I'd also add another benefit of this active asset allocation approach is the bond side gives us the room to increase and decrease our stock allocation. You have to own bonds to be able to have that flexibility, right? That approach is what allowed us to be able to provide some important risk management and downside protection in March of 2020 and in past markets. In March of 2020, we were able to sell treasury bonds in many cases at a premium, right? And turn around and buy depressed stocks. That was not something that anybody saw coming in January of 2020 as they were preparing, right? You've got to have that holding tank to be able to deploy that flexibility.
Yeah, Greg, you referenced diversification and liquidity. I'll use the current environment just as an example. We've had volatility over the past few weeks this year. But to put that in context, the S&P 500 through yesterday was down about 8.5%, is down maybe about 7% with a little bit of a rebound today. And while the bond market is down as well, the bond market overall, the aggregate index is down closer to 2%. So certainly better than the returns that are being seen in the equity markets. Diversification does have its benefits. And when we reach an environment, as we've done in the past, that we want to go into the equity markets, having that fixed income exposure to help fund that is also something that's been very, very helpful.
Having covered the fixed income perspective as well as the equity and the economic over the past, outlook slides that we've gone through, it's probably time to change gears now and discuss what we're actually doing about that within client solutions and investment strategies. And here we're reusing the title from our outlook that we recently published about a week or so ago, Shocking the Status Quo. And what does that mean? Really, that's a statement towards some of the sentiment and the bubblish nature you see in pockets of both the equity market, but other areas such as cryptocurrencies and SPACs and NFTs in a generally easy money environment where everyone kind of knows somebody who's done really well on Bitcoin or Ethereum or some other more speculative investment. And our perspective was that that status quo might be likely to change. And so we've kind of discussed some of that earlier, and we're probably going to get to some of that now. But first, Greg, I want to turn it over to you to go through another quote for us.
Maybe the most quotable, best known investor, right, was Warren Buffett. As a quick aside, my dad is often told that he looks just like Warren Buffett. So if everybody wants to come back for the webinar in 20 years, we can see whether I'm on track with that as well. So it's a good quote, Jerry. It pairs up well with the mantra that a rising tide lifts all boats. When that tide goes out, investors who own profitable companies are able to look to earnings and cash flow in the face of those near-term market declines. Investors who own companies with no profits or free cash flow don't have that opportunity. I think that's a really important distinction when you think about just the philosophy and ethos of how we view risk management and what draws us towards certain investments and why we might not own investments that we find as exciting as anybody else, but may just not want to take the extended level of risk to putting that into a client portfolio yet. It's human nature to always want to give good news. I want to deliver good news. Our financial consultants want to deliver good news, and our clients want to hear good news. And so the good news is that the reviews that we are having right now with clients, looking back on 2021, relative, absolute, there's going to be a lot of smiles, a lot of positive information shared. The 2022 outlook is less rosy, but that doesn't mean that it's negative. Clients just need a plan to manage and mitigate risk in light of their investment goals and time horizon through periods that are great, periods that are challenging, and periods that may be mediocre, right? That may be sort of moderate in between. Again, if you have a plan and you can be proactive, you can take advantage of volatility, but it is really hard to think along those lines in the middle of market volatility and panic selling. Even though in hindsight, it seems like common sense. And ironically, the market gave us an example of that just in the last 2 days, right? I suspect people who were paying attention had a very different emotion at the beginning of the day on Monday than they did at the end of the day on Monday, than they did in the middle of the day, right? We started down, we got way down, and we ended up, right? And you just take a pulse of your personal emotions, right? Getting through that, right? The idea is to pull that emotion out and be able to be more academic and more process oriented, right? That financial plan, that proactive investment management approach is what's going to set you up for success this year.
Yeah, absolutely. And you referenced Monday, Greg, and I know one of our colleagues said that the market on Monday was eerily reminiscent to watching the Bills-Chiefs game in the fourth quarter, and I thought that was very apt. But I do want to zero in on one of your points. Our outlook is less rosy, but it's not negative. Now would be a good time, and we'd like to do a poll for our audience, and we want to see what all of you think. So we're going to posit a question that does have a defined answer, and we'll share that afterwards. And in this case, while we give it a minute, and it's now up on the screen. So here we're using kind of a standard 55-45 portfolio. This is just the market, equities, fixed income. And we said, hey, if you had perfectly imperfect timing and you invested in the market at the worst possible moment during the dot-com bubble or the housing bubble, what would your annualized returns have looked like at the end of last year? So just, one more time while we give everyone a chance. Had you invested at the peak of the dot-com bubble in 2000 or the peak of the housing bubble about 12, 13, maybe 14 years ago now at this point, what would your returns have looked like today? So that's probably long enough. Let's see what the answers look like. I'm a little curious, to say the least. And we have a smart audience, to say the least. Yes, your annualized returns for just the market, again, just the market portfolio, not Manny and Napier, would have been around 6 and around 7%, having rounded there. Greg, I guess I'll turn it over to you.
We're gonna have to make the questions harder next time.
Yeah.
But joking aside, I think as you turn to page 15 and you look at this data, it addresses a couple of things. One of the things this addresses is that question of trying to time the market, because there is this viable question with clients, whether they have cash that they're thinking about putting to work, or whether they're in the market trying to figure out, should I step back until quote unquote things calm down? And if you've got cash on hand, there are strategies like feathering in or dollar cost averaging. But the truth is, what this poll and what this data on the screen demonstrates is that timing the market is less important than time in the market. Not my quote. You've probably heard it before, but you repeat it because it's true. Investors putting money in at peak levels prior to the tech wreck and the credit crisis certainly experienced losses. We talked about those gray periods that were hard to live through, but they recovered relatively quickly, right? Certainly with hindsight looking back, and they're up big through today. Of course, the numbers on the screen here would be bigger if they were being measured from the market bottom than the previous peak. But the point is, investing at the peak, even there, still allows you to make money, right? Well, of course, the other comment to make is, again, we bounce a little bit here, trying to give you data on the market, on economic data, and also on our client portfolios. What's reflected here are the results in our long-term growth kind of flagship multi-asset class investment strategy. And that did protect a little bit better on the downside, and recover a little bit faster in general in both of these environments. So as we think about results and pivot to page 16, when you capture the period from January of 2020 through the end of 21, so while quick, that is a bull and a bear market environment, it was certainly a strong period for all investors, especially so for our clients. Importantly, this wasn't because we were swinging for the fences. In fact, if you really parse the data, it was rather quite the opposite. I think that should be good news for clients. We were cautious in early 2020. That allowed us to take advantage of the volatility in March. That set us on the path that even simply participating in the upside that followed, they left our investors in a great place. So from an outlook perspective, regardless of where 2022 takes us, I think the tailwinds are here for clients with an investment approach that's built on flexibility and risk management in trying to achieve their objectives. And certainly that's the case, for clients here at Manning and Napier.
Greg, when you look at this time period or even longer time periods, there are different things that we have in our toolkit to protect investors and to provide superior returns. I've spoken about them a little earlier: asset allocation, making the shift from stocks into bonds and the other way; sector allocation, choosing which areas of the market, both on the equity and fixed income side, to invest in, and then making individual security selection. And so we've been fortunate to be able to use these things in our toolkit as an active manager to benefit clients with the results that you see on this page. It's also, I think, a good time to remind everyone that volatility, like we've seen over the past couple of years, and we think is likely to continue over the next many years, is a good environment for active managers. When you have an environment which we've had in many cases over the past many decades, which is relatively low interest rates and very easy money, that environment generally inflates all assets. So if you've been invested in stocks, you've done well over the past many decades. If you've been invested in bonds, you've done well over the past many decades. And if you've been invested in real estate, you've done well in the past many decades. But in a more volatile environment and an environment that we think is likely to not see declining interest rates and less fiscal tailwinds, being an active manager and making right decisions becomes critically important. I also wanted to take a moment and touch on risk monitoring and risk management. It's critically important to us to provide our clients with superior returns, but it's equally important for us to do it in a risk managed way. We recognize that our clients are not just accounts to us. These are people who have worked a lifetime so that they can retire with dignity, or they can fund a college education for a child, or provide money for a charity that is near and dear to their heart. So making sure that we provide downside protection is really important to us. And we do this through a dedicated role on risk monitoring. Over the past couple of years, we have strengthened that role even further with the work on ESG, or environmental, social, and governance factors, playing into our risk framework overall. If I could, I'll also dig into something that's been referenced by Greg a few times in the webinar today, which is finding individual companies that can do well in this environment. And this is something that our investment team gets very, very excited about. I should point out we have a deep investment team. It's made up of people on both the equity side and the fixed income side. We have a deep team that does bottom-up equity analysis. We also have a team that looks at top-down factors like the economy and inflation and interest rates. But if I could here, I'll focus on the equity side and on specific areas. So you see on the top 6 different areas that we are particularly enthused about. These are thematic areas that we think growth is occurring, and we're finding individual companies and are excited about them. I'll reference a few of them if I could. Payments, whether it be more traditional companies like a Visa or a MasterCard, or kind of newer companies like a PayPal, there's a lot of growth and a lot of disruption taking place in payments. It's something that we've invested in, and it's something that we continue to look to find opportunities for clients going forward. I'll touch on gaming. Gaming is a fast-growing area. It's gotten a boost over the past couple of years as people are spending more and more time at home. But this is a long-term trend that's been with us for a long period of time, and I think will continue to be with us. And whether it be in the US through companies like Electronic Arts or Activision, or whether it be internationally with companies like Sea Limited, Ubisoft, or Sony, we have had many investments for clients in this area. And lastly, if I could, I'll touch on the consumer area, consumer staples, whether it be food or whether it be household products companies. Again, in the US, through companies like a Coke and a Pepsi, or internationally through companies like Nestle and Unilever, we have multiple investments in this area. So really quite the gamut of investments, from disruptive technologies like payments, cloud computing, gaming, and biotech, to some more traditional areas like consumer staples and real estate.
Yeah, finding opportunity wherever we can. So that brings us to the close of our prepared remarks. And Greg and Evie, thank you for your insights today. Before we turn to open Q&A, I do want to make sure all of our listeners know that if you have any questions, please feel free to reach out to one of our financial consultants, as well as take a look at our website. We have a multitude of resources on these topics, both investing topics on our markets and economy blog, as well as financial planning topics on our financial planning blog, and other insights in our library as well. So we encourage all of you to take a look and subscribe. Also, we have an awards page. We'll share the link in the chat as well. So with that, let's get to the live Q&A. And we do have a number of questions live, as well as a host pre-submitted as well. So we're going to get to as many as we can that we believe are as broadly applicable to the audience as possible. And so with that, we did get a lot of questions both now and previously just on what's been going on in the market in general. So Evie and Greg, I know that we did a lot of thinking and preparing for this event, and with everything that's happened and the current market backdrop, can you comment on exactly how we are thinking about the market given the reality of the situation today?
Glad to do it, Jerry. I think we've touched on some of the topics so far in the webinar that relate to that as well. For the reasons that we've outlined, less fiscal spending, more inflation having reared its head and interest rates likely to go up, valuations being somewhat extended, we do think that we are entering a period of more volatility and likely somewhat lower returns as well. And I think, as we've outlined, we're trying to use everything in our toolkit to protect investors and position investors correctly in that environment. But it's important to put this volatility in context. As I referenced earlier, if you go through today, the stock market is down about 7%. The bond market's down about 2%. After the stock market, as I mentioned earlier, having been up 28% last year, still a pretty spectacular return over the past year. And so we're navigating this environment and trying to protect investors, but it's important to stay invested and to not overreact to volatility in the marketplace, but actually view it as an opportunity for clients.
Yeah, I think some of our clients watch the markets very closely. In fact, I think some of the folks on the call today, this might be their pregame for Chair Powell coming on at 2 p.m. Other clients know us well enough to let us do some of that worrying for them. So I think we answer that question, knowing that we've got a lot of different client types, a lot of folks listening. I'll say I think it's hard not to be a little bit uncomfortable right now. It's been a rough start to the year. The world is changing really fast. Our job is to remove emotion from the investing process. And so I think as we look at year to date, I'll echo EB. I think we want to neither overemphasize or underemphasize what has happened. It's not insignificant, particularly if you're a high growth tech NASDAQ investor. Like, it's been a little more painful, right? But to EB's point, like NASDAQ, maybe it's down 11, 12%, S&P down maybe 8.5%. Our clients, our kind of flagship extended term, long-term growth clients, probably 5.5%. Conservative clients, maybe 2.5%, right? If you started with $1 million in January of 2022, this is meaningful. If you started with $1 million in January of 2021, it puts it more into perspective. So could this become something bigger? Of course. But it's a reminder, like the market experiences 10% corrections almost every year, sometimes more than once. We just don't notice because it typically recovers before the end of the year reporting. Furthermore, we haven't had as much downside volatility in recent years. So we may not have had that in, last year, in the past years, like we have on average historically. So it feels a little bit different. I come back to our comments earlier about time in the market versus timing the market. Doesn't mean that timing doesn't matter, but it means that if you have a plan, you can sleep more easily, knowing that you're going to be able to make it through whatever the near term delivers.
I'd like to turn our attention now to a little bit more specific question, and this is one that does tend to come up with regularity, although perhaps less regularity than it did when Bitcoin was at 65,000 as it does today. But EB and Greg, this question, and I'm going to read it specifically: how do cryptocurrencies fit into investing strategies? EB, maybe I'll send it over to you first.
Jerry, I'll maybe take the question even broader than just crypto, but then reference crypto as well. I think crypto is part of a broader trend of decentralized networks. And so whether it be through cryptocurrencies, through NFTs now, DeFi, et cetera, the common theme around all of them is kind of decentralized networks. The technologies underlying these things, like blockchain, are real. It's something that we are spending a lot of time on and doing a lot of work on. I think they will over time have impacts on many areas. We're looking at, for example, what's happening with payment systems, the ability to trade cryptocurrencies, impacts, frankly, on gaming technologies, et cetera. So this is a real technology which will have serious ramifications and impacts over time. I try to delineate that, if I could, from just the specific question that we often get on cryptocurrencies and buying them in client portfolios. I think cryptocurrency specifically, we have not bought in client portfolios, and we are more focused on the underlying technology and how it influences things. It's frankly hard to put a value on many of these cryptocurrencies, There's a tremendous amount of volatility that takes place in these cryptocurrencies. And then, so if you got invested very early on, you might be feeling great last year, but also point out, as you referenced, it's down by half, basically, from its peak that took place in the second half of last year. It frankly, this environment, frankly, in some ways reminds me of the tech situation of the late 90s. Real technologies related to the internet emerged. We were really intrigued by it, and we did a lot of work on it. But it was a few years before we thought things had become clearer, and we were directly investing for our clients with that behalf. And I think that's the same thing that we will look back from many years from now. A real technology, true disruption. But in many of these cases, I think it's early days, and frankly, I think some of the areas that we're being asked about, there's a lot of speculation that's taking place.
That's right. Crypto it's hard to talk about sometimes because it means so many things to so many people, and because people get so passionate. There are people that are very passionate about cryptocurrency. And I think we again try and take the emotion out of some of that. To some people, crypto is a currency. To some people, it's a store of value or an investment. Other people look at this, to Ebi's point, around decentralization, right? And all of those are true to some extent. None of them are perfectly true. That should be no surprise, right? It's still a very new technology. As Ebi said, blockchain, it's an important technology that is only going to become more widely used. It's not going away. It's something that we've been evaluating. Just because we don't own it directly doesn't mean that it isn't reflected and being, in the portfolio or being worked on inside some of the companies that we own. And I think Ebi's example of the internet is right. Like, even if you loved the idea of the internet in the 90s, you couldn't buy the internet, right? You couldn't invest in the internet. And trying to pick the winner was dangerous, right? And we saw that through the late 90s, early 2000s. But so is not understanding how the internet was changing the world, right? That was probably as dangerous, if not more dangerous. But sort of being able to read how that flows throughout the economy and how it affects other businesses, I think is really the value that we're bringing. And I would just add a final note, because I know there are people passionate about this. There are meaningful tax implications with cryptocurrency for anyone who is trading that. So as I wear my financial planning hat, it's just something to think about as we come upon tax season here.
Yeah, absolutely. All right, I got two, Ebi, that I want to send your way back to back. I'm going to pause in between them, but the first one, we got a couple of questions on this, so I'm going to aggregate them here. Ebi, what is our latest thinking on the energy sector and oil specifically?
I'll maybe put it in, I'll address the current thinking, but I'll put it in context over the past few years. As many of you are aware, one of the investment strategies we employ is known as the hurdle rate strategy. We use this to invest in commodity companies, including, for example, energy. And in a nutshell, that strategy tells us that when there is too much supply, there's not enough demand, when prices are low, when these companies are losing money and losing cash flow, when there's really a panic going on, we buy into that environment. So you saw that take place, for example, in 2020. Energy was depressed, a lot of panic taking place in the marketplace. That was something that became more attractive to us in client portfolios. But equally strongly, that strategy has told us, and we see this play out year after year, cycle after cycle, as prices rise, cash flow increases, valuations increase, stock prices go up, all that we are seeing today in that sector, inevitably they lose discipline. They start to invest more and more in supply, and eventually that causes the commodities price to come down and causes this whole cycle to play itself out in a negative way. It's almost impossible to time this market perfectly. But what I would say is that in that cycle that I outlined a year ago, we felt where things were not so good, and we were excited about buying more, or even 2 years ago. And today we think we are closer towards the upper end of that cycle. Do we know that it has perfectly peaked? No. But what we do know is that when you add chips in this environment, you're taking on more and more risk, and the likelihood of a shock is increased. So we continue to have some investments in the energy sector, but directionally, we're taking chips off the table. We're investing less in the energy sector, reflecting what I just spoke about.
Ebi, and if I could go right back to you, we got a couple of these beforehand, but a few more live, probably because of the headlines right now on Russia and Ukraine. A few weeks ago, maybe a month or so, it was certainly geopolitical tensions regarding China. Can you talk about how these factors work their way into how you guys are evaluating portfolios?
Yeah, glad to, Jerry. We have a global strategies group that looks at international factors, including geopolitical factors like this. So it's something that we clearly spend a fair amount of time on. But I think it's important to delineate between political events and economic events. Sometimes political events, like what we're talking about, have economic ramifications and they bleed over into the economy and the marketplace, but they don't always do so, right? So we're watching this closely. And at the current time, I think it stays more of a political event rather than something that will deeply impact GDP growth or the growth for companies or profitability overall. So a factor that we look at and evaluate.
Fair enough, and thank you for the color on that topic. Greg, I think we're getting a little tight on time. I do want to make sure that you have a chance to address this one because this came through in a number of different ways. And we got several questions on financial planning, many of them with people starting to think about taxes, thinking about gains, and what they could perhaps do proactively should tax rates go up. I know that's been a concern for quite a bit of period of time now. Can you touch on some of how we are helping clients think about these issues?
Yes, absolutely. Let me maybe bucket that in kind of three categories. So let's start with taxes. Most importantly, they're no fun, but you only pay taxes when you make money, unless something's going wrong. And we work with clients to plan for and manage their tax liability. That's most directly done through tax loss selling. There's no free lunch given the wash sale rule. We're always going to try and work with clients to prioritize the investment decision ahead of the tax decision, but we want to be as tax efficient as possible, right? So tax loss selling is a great tool. It's just less available when the market is so strong, like it was last year, right? So options are more limited there than they've been. But I've got some good news on the sort of tax management front. We are in development on a more formalized and sophisticated tax management strategy. We're going to need this year to make sure it's ready for clients before we roll it out. But it's really exciting to have that on the horizon. It's going to be a big value add as we're able to start talking with clients about that later this year and early into next year. Maybe second bucket, I know clients are likely eager to know about tax documents. 1099-Rs for IRA distributions are likely going to be out here by the end of this week, certainly by next week. Full 1099 tax packages vary. Unfortunately, we are not the holdup here. For most of our clients, we are using every tool in our toolkit, and some of those toolkits, some of those tools involve WIFITs. And we ask your financial consultant, they can explain the nuance of this, but we have to wait to get reporting from others. And so for a lot of our multi-asset class accounts, it's likely going to be mid-March before we get the full package out. Any clients with accounts that did not hold those, it'll likely be out by the end of February. I know that's not great news. It's worth noting there are other firms, in fact, many of the large firms will send out 1099s earlier, but will often then send out a correction when things change after the fact. And so while I know it's frustrating to maybe have to wait until mid-March to get this information, I promise it's way more frustrating to get it in early February, file your taxes, and then get a correction that you then have to go back and refile. That can be costly and frustrating. Broadly, kind of in the third bucket, I'd add, we have meaningfully grown the number of planners and CFPs amongst our ranks. I'm proud of that, as the leader of the team. I think that really flows through and is going to have big implications for our clients. I think clients are getting great advice today. I think that's going to continue to get even better. Many planning topics that I could touch on here are simply client specific, right? So I know our team is reaching out. I know clients are reaching out to set up appointments over the next few weeks, get things on track headed into this new year. I would point out a couple of things. If folks are not signed up for some of our email lists, they're great. They're brief, they're informative, they're to the point, and there are different areas for different investments: financial planning, markets and economy, endowments and foundations. Make sure you get on our website and sign up. I promise it's not overwhelming, and I promise you will find value in it. Prosper Magazine is an annual publication we put out. It's beautiful. It's award-winning. But what really matters is that the content's really good. It's a wide array of content written all by our people. You can get a copy digitally. We'd be happy to mail you a hard copy. So again, you can go on through the contact us form. I think we may be posting some stuff in the chat. I would love to get one of those in everybody's hand on the call. And then the last piece I'll mention, most of you likely already know about and use our tax guides. These are really helpful resources for our clients in sort of knowing about changes in, everything from RMDs to contributions to 401ks, different tax rates, just as you're planning with your financial consultant here, as you're planning with your family and coming forward with your questions. And certainly this is something that you can share with others. It's wide circulation, and frankly, many of our clients come to us because friends have shared these documents with them over the years. So I'd point out a couple of things there that hopefully are helpful to folks on the call in terms of planning, Jerry.
Yeah, absolutely, Greg. I appreciate you going through that resource roundup. And if you have any questions on those resources or personal questions on your individual financial situation, please don't hesitate to reach out to one of our financial consultants. We can get you in touch with either the right person to get you the right kind of advice or onward from there. I know we are getting tight on time, so I do want to say I see a number of questions on real estate opportunities, for example, and I know we've got a lot we would love to say on that particular topic. Treasury holdings, specific questions on ESG, looking for more detail there, and diversity, and how a whole array here. We are tight on time. I do want to say that we will be sure to follow up with all of you for submitting those questions live after the presentation live today. And as a reminder, a recording of this webinar will also be emailed out shortly afterwards. So again, please feel free to continue to reach out if you have any questions or needs. Greg and Eby, thank you both for being here today.
Thanks, Jerry. Thanks, Greg. And most importantly, thanks to all of you on the call, not just for listening to today's webinar, but for trusting us with your retirement money and your investments. It's a responsibility we take very, very seriously. And thank you.